big issue there is we have record low inventory. We haven't seen the number of cows and beef at this level since 1950s.
Among the first Americans to feel the effects of the last trade war with China were farmers.
There's already farmers going out of business because the last 3 years the economy has been so terrible.
So currently we're kind of experiencing what our people are calling a hyper cycle. Typically, a cattle cycle usually lasts around 10 years. We're currently in the 12th year, 7th year of contraction. A big part of that, of course, was the drought and the poor pasture conditions we've been experiencing, which led to farmers selling their cattle. And now that tightness we're feeling in the cattle inventory is leading to higher prices. We're seeing the drought issue kind of resurface again or just continue to be a problem. And with the prices where they currently are, it's just not super enticing for people to be retaining heifers. Usually these high prices would signal that it's a good idea to expand, but I think there's like this mentality that these prices aren't going to stay. And there's just so much volatility and outside factors in these markets, especially with the funds on the futures side. So the effect of that is kind of being that limited herd expansion, which makes it feel like we might be stuck in a feedback loop of sorts. Like a lot of analysts are projecting that we'll see these effects of the shrinking cow herd in 25 and in 26 until we start seeing some improvements there. And I think there's just some concern that when are we going to start rebuilding and how does that look? Then there's another part of the market, which is the demand side. So even with the high prices and some of those economic concerns that bled into the markets in the past couple of weeks, we're still seeing really strong demand. We had a very supportive cold storage report at the end of March, and that data just signaled that demand is still strong. Maybe some of that was buying ahead of tariffs, but regardless, we're still seeing a good kind of picture there, which helps keep prices elevated on the meat side of that. I think that kind of signals like to packers that they can offer those higher prices to feedlots, and in turn, those feedlots can sustain the higher prices they're currently offering to ranches. So just kind of continuing that cycle that we're stuck in, I think it has to happen, it has to change at some point, and that's where some of those fears from like 2015, 2016 bleed in. But overall, I feel like the market feels relatively strong for the near term. Some of that is going to lead to really good opportunities to market this summer, especially when we typically see those seasonal increases in prices with grilling season. So really just looking forward to those months to understand your bottom line and use those opportunities to put a limit on your losses, because the higher we get in these markets, the bigger the downside risk is. And then just one other thing, I guess, is just the cattle on feed report from yesterday. We did see an increase in placements, 5% year over year. I would take this with a grain of salt just because last year's March placements were lower. So what that 5% increase really means is probably less to the market than a typical report. So this one feels pretty neutral. And then we did see a slight decrease in heifer placements. So maybe we're starting to see some of that rebuilding of the herd that would, of course, lead to these prices eventually correcting a little bit more. And then, one last thing, I guess, just on the future side, another signal is how we see that spread in the front month versus the deferreds. So that's typically a bullish signal. So keeping an eye on that over the next few months is going to help us kind of keep a touch on this market on whether or not this upwards trend is going to continue, or if we're going to start seeing some softening in prices after the summer.
So I'd add on to that to say that during these times, this isn't something we haven't seen before. This has happened before. And the most recent time we saw it run up like this was 14 and 15. And then it was followed by a huge fall. Some things to think about. I know that people think we're headed to a new equilibrium. I've heard that my entire career. I don't even know what that actually means when they're actually saying that, because the one thing that's certain is that the uncertainty is more than it ever has been in our markets. We have a lot of things that are going on that are out of our control that will affect cattle markets and can rapidly. So I think that when you look at the markets, you have to do exactly what Katie said. You have to take it with a grain of salt and understand there's a lot of external pressures here that are hard to get your hands wrapped around. In addition to the heifers on feed, a large part of the heifer numbers that are taken in on the market are used through survey data pulled from USDA. And those are things that are hard to get your hands wrapped around, because as we see in the legacy farmer, a lot of our producers aren't good at managing their inventory, livestock inventory, much less reporting that up to the proper agencies. So if rains start kicking in and we start producing a lot of more cattle that are going to go into these sale barns, then the fall could be rapid and fast. I think for cow-calf, we've got to be really mindful of the input costs that are going on here. Same market pressures that we have on the selling side, we're also having on the buying side that we've got to take into consideration. Katie and I have discussed that outside of the normal corn and soybeans, which we're a surplus market in corn and soybeans, we have lots of things that are manufactured overseas. Most of our vet meds are made in Europe. And so with these tariffs and stuff that may take into account, those are things that are going to affect the cow-calf market. All of our mineral is manufactured somewhere else. So cost of production could rise for the feedlots. Obviously, with the higher cattle prices, they've got that other additional input that they're bringing into the feedlot by buying cows and feeding them out, especially if they're company owned. Honestly, company owned cattle would be a very high risk business to be in. So hopefully in the long-term sustainability that these guys are really working and pushing to have customer fed cattle on in their yards rather than company owned cattle. I want to point out that the interest rates and the interest rate changes are a reflection of unemployment and inflation. That's why we adjust them at the Fed level. So right now, the reason that the Fed has raised interest rates is to slow inflation. So when we think about cost of money, people think about interest rates and they think about how that's going to affect their ability to borrow and ultimately how that one item is going to affect their P&L. The reality is if we're raising interest rates, we should also be concerned about the other elements that are going into the business, the inputs, the chemicals, the fertilizer for cattle feed, all of these other elements that we're trying to raise interest rate to combat the inflation that those items are seeing. So those are serious considerations whenever you start seeing the Fed changing these interest rates, and something important to understand as you are looking at your business model for the year.
I think another thing to add with that as well on the inflation side is, of course, the consumer demand and just relating to general economic conditions. But currently, beef prices are very high. We're nearing non-COVID historical highs. So if we start to see those recessionary concerns seep into the market, it's likely that those prices won't be sustainable for demand. And then how does that trickle down into the different across the supply chain for beef?
Absolutely. And I would also add on to that to say that people need to be aware that beef is a superior good, meaning that we consume that when there's excess income in the economy, things are doing well. As the economy faces recessionary pressures and or depressionary pressures, we move from beef, we move into pork, and we move into consuming more chicken. We saw a lot of that even in the recent years as we went through COVID. So those are things to really take into consideration as you're thinking about holding on to cattle, which I do not advise during this time frame. Holding on to cattle is essentially you are buying those from yourself. There's an opportunity cost, a trade-off here, to where if you're holding on to that calf right now, you're saying that the market is something you're willing to trade off at that value to retain that calf right now. You're buying those calves from yourself at a very, very high price. So keep that in mind as you're making your decisions for your operation going forward.
Yeah, I think it's a natural kind of escalation of the ag industry. We're seeing larger operations just be able to profit and produce at these high cost of money, high inflationary environments. So the biggest thing that means for smaller operations is just really understanding your bottom line, understanding all of the inputs you're putting in and trying to find areas of improvement. And all that obviously starts in getting these data points put into your cash flows and your balance sheets and being able to dig into the actual bottom lines for your cattle.
And from Katie's perspective, also having a good sound marketing plan as well. In my career, I've seen a lot of people try to end up stepping on dollars for the sake of pennies. That ends up costing them a lot of extra money. The one thing that I would want to stress is that with these historical highs that we're seeing in the cattle markets, the ability to move up is going to be highly limited compared to the potential downfall that we have in the future here. We need to be managing that risk. We were looking at LRP prices earlier today. LRP is a really good, useful risk management tool. Understanding your break evens, like Katie said, you got to understand how to budget yourself, understand what it costs for raise per calf, and making sure that you at least cover yourself in terms of paying back the operation when it's got into those animals. So being mindful, being able to project and managing your budget through the year are going to be more important than they have been even in the previous years.
And truly understanding what all their input costs are and working to get that all organized in terms of like data is going to be the biggest step. And then that's going to allow you to see what your break evens are and then apply that to a marketing plan, whether that's options, LRP, or using futures. There's a lot of different strategies you can use on the risk management side, and that's going to be based on your personal business, but it all starts at just collecting that data and really understanding the numbers.
And taking that one step further, there's two different levels of break evens that every cow-calf producer really needs to be paying attention to. It's their herd break even and their per calf break even. And so sometimes you will see a huge deviation with the herd break even from the calf break even, which is an indication that we have non-producing assets within the herd. I've seen that over and over and over again in my years of banking. We need to make sure that we're investing in cattle assets that are going to pay the farm back. If they're not actively producing and they're not being good players for us in our operation, we need to have a good system in place to identify that and get them out and really reinvest in the animals that are carrying the farming operation forward.
There's two different ways that the trade policies are impacting just the US market in general for beef. We've got the import side and we've got the export side. So part of this idea of tariffs is placing some type of tariff on imports of these products so that US produced goods would be able to have a fairer chance in the marketplace. The way that they're currently set up is a 10% tariff on Australian beef. So I think it's important to mention that currently lean trim from Australia is still outpricing US beef regardless of the tariff. So we likely won't see a huge shift in the changes in prices there and like seeing an increase in demand for US lean trim. On the other hand, if we lose out on export business, that of course pushes prices a little bit lower, might make it more reasonable for US consumers to increase their beef purchases because it's more reasonable for their wallets. So that's how it can kind of impact us on the US portion of the market. Then we've got, of course, China. That's the biggest concern in this place, is that not only are we having these retaliatory tariffs on US goods into China, but also Beijing didn't renew their export registrations for hundreds of the US beef facilities that they had previously had registrations for. So losing that trade flow in general is a risk for demand. We've already seen that kind of come off on some of the USDA export reports that they push out. But on top of just the near-term demand, we also have the fear of just losing those trade flows in general and the permanent shift of moving that demand from US beef to places like Australia. We saw this after the last round of tariffs in 2019, some specifically in the soybean market. Those trade flows didn't return to the US after these tariffs were removed. So it's just a matter of kind of some of those changes in the overall trade flow of the US and the world is going to be a big concern moving forward. And how does that shift demand in the US? Are we going to see US consumers make up for that? Or are we going to have to find new trade flows with other countries by, obviously pushing off these 90-day tariff in hopes that countries come in and purchase US ag goods to kind of change that trade deficit and improve their tariff rate?
A tariff, just kind of getting to its simplest form, makes it more expensive for other countries to buy our product. And so that will actually slow demand for American beef. And so tagging on to what Katie said, maybe that'll add a little context to if people are having a hard time understanding what a tariff is, what it does. It's a tax basically on other countries for doing business with the United States. These tariffs could either be, probably a lot of them are going to be short-lived, but that's still going to be something you need to be prepared for in your marketing plan, and as well as when you're managing your costs for the year.
We're just currently dealing with higher feed costs in general due to a combination of factors, including reduced hay production due to the drought conditions and then increased demand for grain-based feeds. We also have a tight balance sheet for corn at the moment. The most recent WASDE report showed that even continue until new crop, since we're not going to have any corn in the bins until the fall. And with higher corn prices, we have lower feeder prices, like they're an inverse market relationship. So there's that portion of it that affects the business, as well as just the issue of having to buy these feeds for your cows, like how expensive or where your break even is going to sit if you have to increase the input costs there. And then, we just have less room this year for weather issues on the corn side. So I think that's a big concern going forward.
And then dovetailing into that, talking about the other elements that go into feed. Outside of corn and soybeans, we've got a lot of trade partners that we rely on for things such as mineral and veterinary supplies that we talk about. All of our trace and micros come from a different place. we really have to be mindful of the fact that those things are probably going to go up, which is going to raise the cost of production, which I'm going to sound like I'm beating a dead horse when I say that we have to be very, very good at budgeting and managing our expenses going forward, even beyond 2025, because the volatility in this market is higher than it's ever been. And we've seen that over the last 10 years in particular. I don't expect the volatility to change. The volatility factor is probably going to get worse as we get more and more influence in the market. So we have to be very mindful of our marketing plan and our cost structure on our operations.
Yeah, and being someone who's had like experience working in the feed industry, in the marketing side of it for a few years, when you have that volatility in the market, it's a great time for the feed companies. They're making tons of money off of that, but they're never going to push those savings onto you. So when aminos and micros and all these other pieces are going up, you're going to face the brunt of that. And then even if they do find some decrease in price at some point, you're not going to see that directly correlate to your feed costs. It's going to take longer, and you're going to have to be stuck with those prices for a while. Not having a marketing plan, not taking advantage of programs like LRP. I mean, I could talk about this all day, but I think the lack of education is part of it. And also just, why would I pay for something if it's maybe won't do something? That mentality really has to change, because especially in a market like this, we've talked about it, how much higher can it go versus how much downside potential there is. So even if you don't want to spend a ton, taking some type of out of the money put or LRP on a lower price that potentially maybe the market won't get there, but why would you not pay for insurance? Like, why you wouldn't drive a car without insuring it? You wouldn't, even if you don't use it. It's just this idea of this is a cost that should always be associated with your business, and we have to fix that mentality and just not be uncovered, because the most dangerous thing you can do is have all of this money sitting in your operation based on these assets, and then they lose value like that if the market crashes.
And I'll get a little more emotional about it, because I've seen too many producers go down in these type of markets. And I'm going to say this to every cattle producer that listens to this, that you are the worst speculators on the market that has ever been born in this entire world. And do not listen to your neighbors. Do not listen to your friends about what's going on in the cattle market or cost of production or whatever else. I'm going to guarantee you they're wrong. They do not have the information. They do not have the education and the experience to be making recommendations based on your livelihood. You have to be sensible about where the market is. To what Katie's saying, you have to manage the downside risk, because the downside risk has never been higher. Being at the highest price we've ever been at means that the downside risk has never been higher. You could fall off this cliff and the cost of production is going to continue to rise, even though our cattle prices are dropping, which means the moment in which we start losing money will happen faster than it normally does. So guys, be mindful of what is going on and be sensible about who you're employing to help you with these decisions. They shouldn't be thinking about expansion at all right now. The opportunity to expand has passed. We are in a sell market, not a buy market right now. If we're expanding and this is the time and the opportunity that you've saw to restock pastures and all that stuff, which is going to be kind of interesting given that we have drought conditions mostly across the US right now, then we're going to really have a hard time budgeting if these prices start moving against you, which they will. This is not a sustainable price figure probably for the long run. We're just going to have to wait and see it play out. But the reality is, if you're expanding right now, you're in the wrong cycle of business.
I agree 100%. I think just maintaining herd size, if you want to stay in the business, that's the best route, and improving operational efficiency is really going to be key in navigating some of these upcoming challenges. And maybe if it's realistic for your business, thinking about diversification, exploring other alternative revenue streams. I know some customers have gotten into like direct to consumer sales or value added. I mean, these are not always applicable to businesses, but some of those new channels can help you, evolve your business into something that will be more stable financially in future years. I think just the downside risks we've talked about a few times, of course. We're at these super high prices and people just get not greedy necessarily, but they get excited and perpetually bullish. So I think a big risk is being uncovered at this point. Opportunities is taking advantage of these prices. When was the last time you saw stuff this high? Why would you not take advantage of some of the marketing tools that you can use? And that's just going to be the biggest stressor, I would say, is in the next few months, start thinking about where your break even sit, what makes sense for your business, and get a solid marketing plan in place.
One of the big pushes here at Legacy Farmers to make sure you have a sound plan for each year that you're in operation. So we really push that you make sure that you do projections. Nobody likes doing them because they're wrong 100% of the time. We acknowledge that, but that gives you a roadmap to success. The other part of it is not only doing projections, but we work towards measuring our actuals as the year progresses against those projections to see how far off of the road we're getting, or if we're right down the middle of the lane. We need to make sure that we understand where we're at all times. We can manage our break evens, and then ultimately getting back into Katie's expertise, which is marketing plan and managing the offtake risk off the farm. So you really need to understand these things. We work hard as coaches to understand break evens, to understand your cash flow, and how that all works into building long-term wealth for operations. Government programs are going to be important. So crop insurance is obviously a part of our farm bill. And then there's Title I programs such as ARC and PLC. Then there's conservation programs. So conservation programs have really started stepping up in the last several farm bills and starting to be more directive towards on-farm efforts has kind of been their objective. The one conservation effort that a lot of people are familiar with is EQIP. There's a lot of pending EQIP money out there right now that's on freeze. The question is if that's going to ever become available. We can only speculate, right? And we have to look at the environment around our politics. What we've seen is we have a very, very farmer-friendly, producer-first ag secretary that's just been appointed in Brooke Rollins, and she's very close to the president. So in spite of all of these freezes that we've seen in other departments, the first thing that we've been able to experience as ag producers is they have started tranching out the ECAP money. So ECAP has been rolling out across the country, and that's a little bit different. That's an ad hoc program. Honestly, they hate those programs, but it was put in place to help with all of the issues that we've had over the last year. So I have a lot of optimism that this EQIP money is going to get freed up probably a little quicker than a lot of other initiatives that the government is undertaking for a couple reasons. One, I think that the current administration is sympathetic to the agricultural environment for a couple reasons. They understand that we produce most of the world's food. A lot of these tariff situations and these trying to go back to the table and renegotiate trade arrangements is hinging on our ability to produce food and sell food to those people. A lot of countries really rely on our country to feed their people. I suspect that some of those agreements will get made sooner rather than later, just on the basis of the fact that we supply so much of the world's food. The second part is, if you look at who put Donald Trump in office, a lot of the rural communities really put their chips in his basket in hopes that things would move forward. I think that's recognized. I think that's recognized in the process that we're seeing playing out in Washington, D.C. But ultimately, time will tell. The last factor that I'd really like to talk about is the Farm Bill is a very small portion of the overall government's budget, especially when you look at what actually goes to farmers. Over 70% of the Farm Bill goes to the SNAP program. So when we're talking about EQIP and we're talking about ARC PLC and those different items, that's really not a whole lot of money that adds up to significant savings. So if the difference is keeping farmers in business or paying those out, because of the price tag that's attached to those will probably get released sooner than some other things.